Hey, Renter Retires, it's Adam Schroeder here with another episode flying solo today. And I just wanted to come with some quick thoughts to talk to you about kind of what's happening in the real estate world, what deals we've got going on, because it is a strange time to be alive. May you always live in interesting times. We're definitely in interesting times in today's world right now. We got a lot going on between potential tariffs, well, not potential because they're actually happening, but Congress, starting to fight back against the tariffs and how that's impacting the stock market and how it's impacting market sentiment and how it might impact the Fed and interest rates and all of that stuff. We have a lot going on, and let's dive into exactly what's happening in today's world. So right now, we're seeing rates kind of actually improving in a lot of cases, which is very odd. I don't know if you've been reading, but some people are worried about stagflation, which is when we're starting to see no economic growth, but higher unemployment rates. Well, we're not really seeing that at the moment because the jobs reports have actually been pretty good. And so as jobs continue to come in, that's a positive future indicator for the economy. But obviously right now that's not really kicking in. But part of the reason you want to ask yourself, why are rates coming down? And it's because of future sentiment. We've got a lot of investors who are looking at the future, not just, this year, but not next year necessarily, but over the next 30 years. Remember, they're making a 30-year loan. They're looking at the next 30 years and saying, hey, you know what? This immediate impact might not be as bad as what we were expecting. We think that it's going to improve. The numbers have started to improve around the place. So let's not worry so much about it and let's start coming down. Now, the Fannie Mae Freddie Mac loans, those interest rates aren't dropping as much. But if you look at what the DSCR loans are doing right now, what non-QM money is doing, what the easier loans to get are, what you can qualify the property through as opposed to you, when you look at those rates, you're actually in a pretty good place. I mean, I've closed 2 deals this year. One was at 6 5/8. The other one was at 7 5/8 with 20% down. The first one was at 75% loan to value. This one was at an 80% loan to value. I got a 7 5/8 interest rate. Wouldn't have gotten that on a conventional 25% down loan 9 months ago. And yet we're in a better rate environment than we were then. But yet people still worry about interest rates. They still complain that they're too high. They still say they're not going to get in the market because they're too high. They worry about everything about that rate. So let's dive into the rate itself. Interest rates go up, interest rates go down. If you look at historically from about 1980 through this last year, they've averaged somewhere in the 5% range. Somewhere in the 5 to 6% range has been kind of where they've settled across the board. So right now, you can get, DSCR rates in the 6s. That's not bad. That's a little bit higher than historical averages, but, we also had some time in there where they were basically 2%. So rates go down. And that was also, that 5 to 6% was based on conventional financing. So you look at it now and you think, well, let's see, what have home prices been doing lately? Well, home prices in a lot of places have stagnated. And some of the markets that saw massive appreciation, we're seeing depreciation a little bit. And in some markets, we're continuing to see growth in prices. And why are we seeing growth in prices? Simple supply and demand, right? Home builders weren't building homes. People were moving there. So prices naturally went up. Now, in some of the markets where they were going up really fast, such as Austin, for example, builders came in and just said, wow, look at this. There's appreciation going on. So they chased the tail, right? They're the dog chasing the wagging tail. And so they went and they built 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 and they built. And now we're seeing rents come down. Now we're seeing valuations hold steady or drop. And we're seeing that because it was overbuilt. But if you look at the country as a whole, we're still 5-6 million homes short. If you look at where people are moving, we're still short on inventory. Where are they moving? Same place we've been talking about all along, Midwest, Southeast. That's where people are going. Obviously, they're moving other places here and there. But if you want to look at the general landscape of where are people going, Midwest, Southeast. If you look at what you can buy in those areas and what you should buy in those areas because of, weather-related things or just general market dynamics, rehabs in the Midwest, new construction in the Southeast. People worry about, for example, in Florida, insurance costs. Well, insurance costs in Florida, if you have a home built before 2005, wow, good luck. It's going to cost you an arm and a leg. Built recently, since 2005, brand new construction, I got it for $1,250 for a year with a $2,500 deductible. Come talk to us. Ask your rep. Rent to Retirement. Schedule a call. Talk to us. 90% of real estate investors miss key tax savings by overlooking deductions. Flipping houses, managing rentals, or growing your real estate empire? Make sure you've got experts in your corner, especially when it comes to taxes. That's why we turn to Nevada Corporate Headquarters, the experts who help us reduce taxes and set up our real estate LLCs. With 35 plus years of experience and 17,000 five-star reviews, Nevada Corporate Headquarters helps you manage properties across states, navigate tax laws, and protect your assets, all with a real estate LLC. Visit nchinc.com/RTR to schedule a free real estate LLC formation and tax consultation. Plus, receive a free guide to safeguarding your assets. Insurance is not as expensive in some of these places as it's suggested. However, you have to be buying the right asset type. Just like you look at rents. Rents in some places, like we've talked about, have gone down. Rents in some places are still going up. But also, you look at it and say rents in rehabs are not going up as much as rents in new construction. Or rents in new construction aren't going up as much as rents in rehabs are. You need to evaluate the market and see what's going on. Because there's a lot of places where there's new construction, but the numbers don't make sense. The rehabs are what makes sense. You notice we don't have new construction usually in like the Ohios, the Indianas, the Iowas. They are building homes in those states, but the numbers don't make sense. The rents are still where the rents were, going up 2, 3, 4% a year. And it's not worth buying a $400,000 new construction build because the rent values aren't there. Now, will they be there in 3, 4, 5 years? Maybe. But right now, today, as you look at the properties, they probably aren't exactly where you want them to be. So you need to be a little bit more careful as you go into those markets. You know, a lot of people I have unfortunately seen, whenever I say be careful in the market, whenever I say you have to look at this stuff, I've seen a lot of people not doing their due diligence. Please, for the love of all that's good, if you're going to invest in real estate, if you're going to be dropping 40, 50, 60, 100 grand into a property or more, you know, if you're buying a new build multifamily and putting 250, 300, 500,000 into it, learn to do your due diligence. We talk about this a lot. The Academy dives into it a lot that we have. Whenever you're looking at your property and trying to evaluate it, don't just go off of general numbers. I want you calling the property tax office. We put in our pro formas roughly what you're going to be getting in property tax, but you can never guarantee it. And year one, you're going to be paying a very low property tax, most likely, because you're getting taxed on the land. Year two, it's going to go up. What's it going to go up to? Who knows? Sometimes year two, it doesn't go up because maybe they reassess every 3, 4, 5 years. And you need to find out where you are in that scale. For example, the property that I just purchased, I know exactly what the property taxes were last year. I know exactly what the property taxes are going to be this year because they're not changing the valuations. But the valuations are coming into effect next year in 2026. And so I simply called up the tax assessor and I said, hey, I'm buying this house, $340,000. Here is the address. If it were valued at this today, what would my property taxes be? And they gave me the number. It's higher, obviously, than what I'm paying this year in 2025. But now I know to factor that in for next year as I look at my numbers. Did I just ballpark insurance? No, not at all. Well, when I first started evaluating the deal, sure I did. I said, it'll probably be around $1,000. But then I got the address, talked to an insurance company, actually got the quote before I went under contract on the property so that I would know, will this still make sense at the insurance rate that I'm going to get? And, as you go through everything, don't skimp. You know, some people think new construction doesn't need an inspection. New construction needs an inspection. Rehabs need an inspection. Every single property you buy needs an inspection. What do you do once you get that inspection? Easy. First off, just send it to the provider and say, hey, fix it. Now, most of the time, they're going to come back and say, I'm not going to fix every little thing if it's a non-new construction. And they might say, I'm willing to do this, willing to do that. And you have to decide then if that's worth it to you. Like maybe there's a really old water heater and they say, I'm not going to fix it. And you say, well, then I want some credit off because I'm going to have to replace this water heater sooner than later. And maybe they come back and say, that's nice. We don't care. It works right now. So we're not going to reduce our price any. Then you have to make the decision and say, does this still make sense if in 2, 3, 4 years, this water heater goes out and I have to pay for it? I need to start calculating that into my CapEx expenses. And as you look at your CapEx, you've got, let's just say, a brand new air conditioner, brand new roof, brand new flooring, but you're going to have a water heater expense within the first 5 years, most likely. Well, start factoring that into your account. Set your assumptions. I highly recommend use the wealth calculator that we have at Rent to Retirement. Go in there. It's a free thing. You don't even have to use a real email address. But as I tell people, if you don't use a real email address, make sure you never lose your password because you can't reset a password in an email that doesn't exist. But go in there and start working on your properties, because not only does it do year one, but you can set your expense growth. You can set your appreciation assumption. You can set your rent growth assumption. You can set all the assumptions you want. You can set the loan type that you want, the 30-year, 20-year, 15-year, whatever you're doing. You can set your interest rate. You can do everything. And then you tell it to show you the result, and you can add and subtract properties from it so that you can see how your portfolio is going to work, how one market might be working, how one property might work, and just see what it looks like. Don't fall into I looked at year one and year one looks good. Look at the whole production of the property. The expected production isn't going to be full on accurate. No. Expenses are going to come up that you didn't see coming. Expenses are not going to come up that you thought were going to come up. Maybe that water heater lasts another 10 years. And now you were expecting that expense and you didn't have it. Fantastic. Congratulations. Enjoy not paying that CapEx, but hold on to it because eventually you're going to need it, right? Tardis Wealth Strategies believes you don't need to wait on lower interest rates or a perfect economy to build wealth faster. Their patented income snowball system has already helped thousands of clients create over $6.4 million in monthly income, money they're using to quickly scale real estate portfolios, even for investors out of funds. Book your free strategy session at tardis.com and discover how to invest with confidence in any market. Sign up at renttoretirement.com/Tardis Wealth. So as you go through it, use the tools that are there. I mean, we've got the wealth calculator. We've got our first year pro forma that you can download from the site. There's all sorts of resources out there that you can go to. I know a lot of y'all found us through Bigger Pockets. It's a great place to go and meet other real estate investors and learn about mistakes they've made, successes they've had, all of the things that you need to know as a real estate investor. We have the Rent to Retirement Academy that you can sign up for, and you can, start educating yourselves and get lifetime access, do webinars with us. All of that stuff is there for you to take advantage of, but you have to actually take advantage. You can't expect things to just fall in your lap, right? Make sure as you're doing this, as you're going through the process of being a real estate investor, every single time, I challenge you, every single deal you make it better. What I'm working on personally is every single time I do a deal, I make sure that I improve my data collection. I used to be really bad and just take my closing disclosure and my docs that I sign, and that was enough for me. Now I started downloading everything, appraisal, inspection, insurance quotes, every single thing, everything that came into my inbox got downloaded and saved. Will I need it? I don't know. Hopefully not, right? Hopefully I will never need this stuff. It got sent away by my notary. It's been accepted. Everything's good. but just in case something comes back up, I know I have it. I've got a file cabinet full of all the docs whenever they brought them to my house. Some of them from previous, original purchases. I don't really know where everything is. Maybe I didn't save it as well. Maybe I put it somewhere I would never forget it. But every single piece of paper that came in this time is an improvement from last time. If you own rental properties, you know that managing them takes time. HEMLANE makes it easier, so you can stay in control while reducing the workload. With HEMLANE, you can find high-quality tenants faster, automate rent collection and lease management, and access their top-rated 24/7 repair coordination team. Rent to retirement plus HEMLANE equals a powerful combination for landlords looking to scale. See why thousands of landlords trust HEMLANE to manage their rentals. Book a demo today and get 25% off for 2 months. Book a demo at the link in the show notes below. So I urge you, I beg you, I challenge you, every single real estate investment you do, be a little bit better than you were with the previous one. Do a little bit better due diligence. Do a little bit better, data collection. Do a little bit better demanding fixes in your inspection. Do a little bit better with anything. Just work. Do the work, because real estate is never completely passive. You can make it easier on yourself. That's why I invest in turnkey properties personally, because I want to make it as easy on myself as possible. But know that even turnkey isn't completely passive. You've got managers, you've got a house, you've got tenants. Something of those three could easily go wrong any given day. Will it? Probably not. Not every single day. But eventually a repair is going to need to be done. Eventually a tenant's going to leave. You might eventually not trust your property manager and think they're doing the best job that they could possibly do. So just know that you need to set yourself up for success. You're going to have to be involved. Eventually, you might get involved enough that you can become a real estate professional and save a lot of money on your taxes, like we talk about on our podcast and in our webinars a lot. Zach is a real estate professional himself and loves offsetting all of his taxes. I do some of the same strategies myself. So just know that you can always be a little bit better. If you can just improve every single deal a little bit, even just 1, 2, 3%, kind of appreciate your, you get appreciation on your knowledge, right? If you continue to do that, you will find success in real estate. Stay with it, learn more, and do better. So that's my challenge to all of you today. Really appreciate the time y'all spent educating yourselves with me today. Talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.